what do you want to do about emerging markets? It's a real puzzle that, well, it feels paradoxical, it feels unfair. You've got a growth scare in the markets in general, and the growth scare is mostly about the developed world. We're getting negative growth in Europe, worries that U.S. growth is going to go from 2 down to 1.5, that Japan is not going to grow at all. And we're seeing much better growth than that, although it's coming down in the emerging world. But the real punishment on a day like April 15th, when all the markets fell, is being delivered to those emerging markets. Despite the fact their growth is better, they went down at a ratio about 2 or 3 to 1. So now your question is, you're sitting there and going, okay, long term, maybe these are going to be the big growth markets in the world economy. And how bad is this going to get right now? Because it really determines what you want to invest in. If this is really going to be a bad downturn, you don't want to touch emerging markets at all. That when people get really, really scared, they don't care what the long-term story is. They dump those stocks, they go to the developed markets. So you get maybe everything goes down, but emerging markets go down a lot more. If there's only a moderate pullback, you'll see emerging markets that are dependent on commodities and emerging market stocks that are commodity stocks, such as Vale in Brazil, go down a whole lot because that's part of the global picture. But maybe you'd have, if it's only a moderate downturn, you'd have a good story for domestic stocks. So that a stock like Grandin in Brazil, which sells flip-flops, or maybe Café do Coro in China, or 7&I in Japan, which gets most of its revenue from running 7-Elevens in emerging markets. Those would be good things to buy if this is only a moderate downturn. I think right now, discretion says better part of valor is sitting this all out until we figure out exactly how far people's fears go. If they swing really, really far, you don't want to have any emerging market exposure that you really aren't willing to hold through the downturn. If you've got really good long-term stories and transaction costs in some of these markets are very high, so you don't sell, you just hold on. But in terms of putting new money to work, I think what you need to do is to figure out how bad this downturn is going to be, and we'll have a better sense of that, I think, in a couple of weeks. So right now, as we're in the middle of April, I'd say let's wait until sometime in early May, and we'll have a better sense of exactly how far down things are going to go, whether all the babies get thrown out with all the bathwaters, etc. And that'll help us figure out what in the emerging markets we want to buy and where the bargains might be as opposed to where the falling knives are. This is Jim Jubak for Jubak Asset Management Video.